The Trump administration is taking its fight over tariffs to the Supreme Court. The US government has asked the Supreme Court to hear its case over whether the president's tariffs are legal on an accelerated timetable that would see arguments heard in November. This has made bond investors nervous this week. They were counting on hundreds of billions of dollars in tariff revenue to help offset the soaring US debt. Jeff Yu is Senior EMEA Market Strategist at BNY. Jeff, do you expect a projected legal fight over tariffs to mean further nerves in the bond markets?
Well, it's a bit difficult to say on the legal side right now, but for bond markets, not just in the US, globally, this steepening trend for various reasons, we do see it as a prolonged theme. I think there's several reasons behind that. One is equilibrium rates are going to be high. Many central banks have noted that. We are in a very different global supply environment after the pandemic. And just look at wage growth, for example. Job creation may be soft, but wage growth is high, and I think there's going to be some inflation premium there. Secondly, of course, is on the fiscal side, and this, I guess, where US is a bit more dynamic in terms of if you raise taxes, what tariffs are, then you will see better revenue on the fiscal side. But I think this week in particular, markets more focused on what's going on in Europe and fiscal trajectories in UK and France.
Is the amount of bond supply in the US, though, starting to test the limit of investors' demand for it?
I would actually say no. And this has been a big theme this year, whereby investors are asking, given the supply and given the other issues, are international investors in particular exiting the market? And our view is this is something that's more talked about than actioned upon. In fact, if you look at the long end of the market, so beyond 10 years, even after Liberation Day, our clients were buying this part of the curve. And I think there are two reasons. One, yields are higher. They feel adequate compensation. But secondly, after many years of dollar exceptionalism, the dollar was weaker as well. So for a European investor, you're getting higher yields and at a cheaper cost in euro terms, then why not? So I think, that's why for the time being, given the status quo, there still will be ample domestic and international demand for US treasuries. And to be frank, there still isn't that much of an alternative out there.
As you said, though, we've seen steeper rises in the yields of bonds in both France and the UK, who both have bond auctions this Thursday. Do the auctions show market nerves are easing?
So I think, given the reaction to some of the auctioned figures on Tuesday and Wednesday, for example, it does show that things are going to be stable for the time being. And I note that for the gilt syndication, for example, there was a record level of bids of 140 billion, for around 14 billion pounds of issues. And also I note that about 40% were ultimately allocated to international investors. This is actually above the 31% ownership for international investors that the Debt Management Office has tabulated towards the end of last year. So again, it's a bit like what we've seen in the US, higher yields. Sterling isn't very, very strong at this point. So people feel adequately compensated for that. And for France, so sure, we can look at France on a single country basis, but we know that on a pan-European Union basis, there will be joint issuance, I think anchoring all European governments. So again, for the time being, with the adequate steepening that we've seen, I do see international clients and also domestic clients, of course, feel that they are adequately compensated for the time being.
Does that mean then that the scale of the UK debt in particular perhaps doesn't bother investors as much as it may bother politicians?
I think vigilance is always needed, and we would just shy away from some of the more alarmist headlines out there. It's really going to be a situation where let's see the medium to long-term trajectory, right? And it's about the change as much as the levels. So we'll wait for the budget for the UK. But take Italy, for example. We know that debt metrics are seemingly worse than the UK's, but they're not changing by much. And actually, if you look at the OECD's projections, even see Italy's deficit falling below the 3% line in the sand for EU nations. And it's even going to perform better than Germany further down the line, however, from a high level. So I do think that the government needs to send a message, and they are sticking, of course, to the fiscal rules. But there is a path, for stability, and then you build on top of the stability to try to get growth going and try to grow oneself out of debt. I think that ultimately is the optimal way for all governments involved.
Do you think, though, that European investors and indeed governments need to prepare for longer-term government bond yields across the developed world to be higher than they have been in recent years?
I do think so, and that's something that central banks themselves have been flagging. We're not going back to zero rates. We're not going back to negative rates. So front end and further down the line, steepening is going to be a feature. And I think that this is quite symptomatic of developed market economies. If you do have a job right now, then your pricing power over wages is actually quite firm, especially in the services sector, whereas some other sectors may face challenges. But this also creates the issue where participation, especially in the UK, that could always be higher. So on the revenue generation side, if the total number of people working, even though their job, even if their wage growth is quite strong, payment through income taxes, that could be soft as well. So just getting the balance right. It should be about job creation up ahead, not just in terms of higher wages. So stagflation, that is the view globally that's been priced in. So getting out of that will require deeper reform. And of course, central banks will support them when they can.
That was Jeff Yu of BNY. Don't forget, you can watch more videos on Reuters.com.